You want to invest in gold and silver. Very smart decision. But here is what most people do. They watch a prediction video. They believe, they buy, and they hope. But the real problem is there are no free lunches in this world. Predictions are brutal. They look confident but teach you nothing. Investing based on someone's opinion is deadly. But there is a different way. Instead of relying on someone's opinion, you can understand the actual mechanism of gold and silver and make your own informed decisions. In this video, I am giving you exactly that, a framework that professionals use, the framework that make prediction videos useless. Let's build that understanding. Gold was once used directly as money. Kings paid soldiers in gold. Merchants traded goods for gold. Gold literally was the currency. But around 400 years ago, governments realized something important. Gold is impractical for daily transactions. So the government came with an idea of printing paper notes and made a promise that every single note is backed by gold in our vault. If you want, you can come to our bank anytime and exchange this paper for gold. It was genius move because paper is light, easy to carry, easy to count and more practical. So people loved it and accepted the idea. But here is where the story gets interesting. Slowly over decades, government realized that they could bend the rules. They thought, what if we just print more currency without keeping that much gold? What if we control the value through interest rates and inflation instead? And gradually in 1971, US President Richard Nixon officially ended this system. After that, most countries followed. They said, we are done backing our currency with gold. From now on, the value of currency comes from government's credibility and economic strength, not from any metal. Now here is the million-dollar question. If gold was supposed to be replaced, why didn't it disappear? Why is gold still valuable today? The answer is simple. Gold has a unique combination of qualities. It's durable, rare, divisible, portable, and universally accepted. Sure, there are other things that are durable or rare or portable, but no other physical element combines all these traits in one single form. Not stocks, not bonds, not real estate, not even crypto, nothing. And here is the final strongest proof. Central banks across the world, the USA, Europe, China, India, Russia, they all still hold massive amounts of gold, billions of dollars worth. In fact, they are increasing their gold holdings year after year. But why? Because deep down, even governments know the truth. Gold is the ultimate backup. When everything else fails, when currencies collapse, when system breaks, gold stays. This is not blind belief. This is rational confidence built on 5,000 years of human history. And that's exactly why gold is not just an asset in your portfolio. Gold is timeless money. Gold is the money that never died. Historically, gold and silver were closely valued together. One gold coin equaled roughly 12 silver coins. This ratio stayed consistent across Egypt, Rome, China, everywhere. But in the last 200 years, silver's role completely transformed. See, gold does one job only. It stores value. Wealth storage is its sole purpose, nothing else. But silver picked up a second job. That is industrial use. Now here's what most people don't realize. Silver's industrial use isn't new. It's actually been happening for over 2 centuries. And that's why silver was left behind in the race of value against gold. So in the last 100 years, one gold coin becomes 60 to 90 silver coins. But here's the thing. Silver's industrial demand today is nothing like what it was 200 years ago. Electronics, computers, mobile phones all require silver. Silver is the best electrical conductor after gold. Whenever electricity needs to flow reliably, silver is the material of choice. So silver demand exploded in the 2000s. But that was just the beginning. The real structural shift happened more recently when the entire world started pushing green energy. Each solar panel requires silver. EVs need twice as much silver as regular cars. Modern infrastructures is built on silver conductivity. But what about production? Production has basically stayed flat. Mining capacity hasn't grown proportionally. So now you have growing consumption and stagnant production. That gap matters. It creates supply tension. Supply tension historically leads to one thing: higher prices. Now, here's one more thing most people haven't realized. Since gold became extremely expensive and went out of reach for most people due to their financial constraints, silver naturally became the second best option for wealth storage. So, silver serves a dual purpose now. It serves as wealth storage while also meeting the genuine industrial demand driven by modern technology. This dual role is permanent. This structural shift will continue. Because as long as modern civilization depends on electricity, electronics, and industrial applications, silver will remain in demand. That's not a trend, that's a structural reality. Let me ask you one thing. If you had to pick up just one single factor that moves gold and silver prices, just one, what would it be? The answer is US dollar. And the reason is simple. Gold and silver are traded globally in US dollars. Every country, every exchange, every market. Imagine there is an investor in Japan. He wants to buy gold. He has Japanese yen. But gold is traded in dollars. So what does he do? He converts his yen to dollars first. Then he buys gold. Suppose the US dollar goes up, gold becomes more expensive because the Japanese investor now needs more yen to get the same amount of dollars. As a result, he reduces his gold buying and demand falls. This is called an inverse relationship. When the US dollar goes up, gold and silver go down. When the US dollar goes down, gold and silver go up. And this factor carries the heaviest weight among all factors that move gold and silver prices. If you have some money to invest and you are given two choices, option 1, buy gold. Option 2, put that money into an interest bearing asset that pays 11% interest. Which option looks better? Obviously, option 2. Why? Because you are earning 11% doing nothing. That's massive return. So you naturally move your money there. Now suppose the interest rate drops to 2%. Now which option looks better? It's an easy choice because 2% is even less than inflation. Practically you will be losing money instead of earning in option 2. So you would prefer gold and option 2 will become your opportunity cost. So the logic is simple. Higher interest rates make interest bearing assets more attractive than gold and silver. Central banks control these interest rates. So when they increase interest rates, investors move their money from gold and silver into interest bearing assets. As a result, gold and silver prices usually fall. In short, higher interest rates hurt gold and silver, while lower interest rates help them rise, and this is actually the second biggest factor that moves their prices. Suppose you have milk and you are given a task to preserve it. If you keep it as is, it will spoil. Simple. Now here's the interesting part. Money is also like milk. If you keep it as cash sitting in your wallet, inflation eats it. Your purchasing power spoils, slowly but surely. But here is the clever part. The best way to protect milk is to convert it into ghee. Ghee survives for months and years. Similarly, if you convert money into gold, you protect it from inflation eating it away. Why? Because gold doesn't lose its value. Gold is designed to store and protect wealth. So gold is the insurance policy against inflation. When inflation rises, everyone recognizes this threat. They convert cash into gold, demand spikes, gold price rises. When inflation is low, people don't feel the urgency. They keep cash. Gold demand stays lower, gold price stays stable. It's very straightforward and is the third most important factor moving gold and silver prices. Here is the question. What terrifies you most as an investor? What is that one nightmare you pray never comes true? The answer is the sudden collapse. It's the idea of everything you own becoming worthless overnight. Your stocks, your bonds, your bank savings, and even your real estate. So, when does this happen? When geopolitical turmoil or financial crisis strikes. It could be a war, a breakdown of financial system, a major bank failure, or even a government collapse. These are the moments gold matters. When the world gets messy, gold and silver gets valuable. Because here's the difference. Currencies are backed by a government's promise. Stocks, mutual funds, bonds, or even bank deposits rely on financial institutions and regulatory systems. But gold and silver depends on none. It is backed by collective human belief that they are the safest store of wealth humanity has ever known. This is why gold is called a safe haven. So whenever uncertainty rises, whenever people fear that anything or everything might break, money flows into gold. It's not greed, it's survival instinct and is the fourth major factor that moves gold and silver prices. You may find charts boring, but here's the truth. Fundamentals tell you why, while charts tell you when. Technical analysis decides short to medium term price movements. Trends on chart, support resistance zones, breakouts heavily influence gold and silver price movements. Charts provide better entries and smarter exits. Buying at the top versus buying at support, or holding too long versus exiting at resistance. These are not small differences. This alone can create a massive difference in your returns. That's why technical analysis isn't optional, it's a must. Understanding these five factors means you are not guessing anymore. Next time when you wonder if gold will go up or down, you won't be guessing. You will be reading signals, you will be making informed decisions. Sometimes these factors align, sometimes they conflict. That's normal. But here's the key insight. Professionals don't look at one factor, they read all five. They understand the weightage of each, they combine them. They draw one collective conclusion. This framework is much more valuable than watching expert prediction videos because prediction video gives you opinions. This framework gives you edge. You are in the investing business, so don't guess. Invest professionally.